Many people are extremely bullish on crypto. Often it seems that everyone thinks the future is bright. According to many crypto influencers, the current price drop could be the last chance of a lifetime to buy in one last time at huge discounts. However, this impression could as well be misleading. Many people are thinking negative about cryptocurrencies. This info just don't get to you. On social media, we are often caught in a filter bubble, meaning that we only get reinforcing opinions and contrary information gets lost. I am also caught in this filter bubble, which is why I specifically search for contrary opinions and shortcomings of crypto. Today, I would like to present the other side of the coin, the bear case for cryptocurrencies. Please do not get me wrong. I do not think that everything will inevitably burn down. I would just like to play devil's advocate and show you the arguments of the crypto opponents and critics. First, we got smart contract and code risk. Everything is open source, making it way more easy to find weak spots and break into systems and hack people of their money. Code is visible, making it much more easy to attack crypto projects compared with regular finance with no open source code. Logic errors in contracts or flawed and buggy code will inevitably be found and exploited. Second, scaling is another major risk. Ethereum at the moment can only do 15 to 20 transactions per second. Visa can do 50,000 plus transactions. Bitcoin is even worse, only being able to do 5 to 7 transactions per second. Third, environmental reasons. This is especially a concern for proof of work coins. Bitcoin wastes a lot of energy. Its energy consumption for mining is as high as the energy used in entire countries with millions of citizens. The world's largest cryptocurrency currently consumes an estimated 150 terawatt hours of electricity annually, more than the entire country of Argentina. Population 45 million people. Fourth, we got convenience and custody. There are other issues too. The user experience is way worse than it should be. Using cryptocurrencies and DeFi products is just very inconvenient and not forgiving at all. Every small mistake could cost you your whole funds. Institutional investors partly avoid crypto because they don't know what to do with their private keys. Handling and securing the coins is hard to do, especially when you are a multi-billion dollar investment company managing a lot of money. This is improving though. We got a lot of custodials now, like Coinbase Pro or Fidelity, for example. Fifth, regulatory issues are also huge. The SEC is going after a lot of coins and ICOs for violating security laws. Projects can get shut down or drained out of all their funds. Sometimes people even get arrested. Tornado Cash was a way to make private transactions on Ethereum blockchain. This was used by criminals a lot. That's why the USA is going heavily after the protocol and even their developers. Some even got arrested for contributing to their codebase. Privacy is nothing inherently bad. Software engineers should not get punished for writing code that can be used for good and also bad things. There are legitimate reasons to use Tornado Cash, not only for criminals. Just an example, you want to pay someone you don't trust. You obviously don't want him to see your wallet and all the riches you got in there. That's why you might use Tornado Cash to disguise the address the money is coming from, as you don't want to put a target on your back. I'm rich, come and rob me. It also can allow you to make anonymous donations. Vitalik Buterin, one of the Ethereum co-founders, used it for this purpose. There are even more strong risks from the regulatory side. First, politicians and regulators might try to ban all proof of work blockchains, as they are very wasteful with energy. Many coins nowadays no longer use mining or are in transition to another consensus mechanism. Example, Ethereum. The so-called merge will happen very soon. Ethereum is going to transit from proof of work to the way more energy efficient proof of stake. However, this would hit Bitcoin, the biggest cryptocurrency, very hard. The Bitcoin community holds on to mining almost religiously. Second, regulators will also almost certainly intervene if cryptocurrencies become too big and shake up the existing world order. The US dollar is currently the dominating currency. The USA will certainly not allow Bitcoin to take over more payment functions in the future without a fight. A currency outside the control of governments is still considered unacceptable, and those in power will do everything to counteract loss of control. At the moment, Bitcoin is still too small and insignificant, and people are not worried. But this can change very quickly, maybe in the next bull run already. Now, you may argue that it is impossible to ban Bitcoin because it is a globally distributed, decentralized network. That's true, but the on and off ramps, also called exchanges, for the most part, can be banned quite easily. If Bitcoin is declared illegal, this would also lead to further problems. Institutions would no longer be allowed to trade in Bitcoin, and many retail investors would certainly jump ship. Buying and selling would also become extremely difficult. Transactions with Bitcoin could also no longer be carried out easily, at least not outside the dark web. Developers are also far fewer than users and investors in Bitcoin. Going after software engineers is another way to slow down and hinder Bitcoin's development. Mining could also be banned. Even more nefarious options are conceivable. Miners are not evenly distributed over the globe. After the Chinese mining ban, a lot of mining is done in the United States. US authorities could take over these facilities and sabotage consensus. Regulations in general become harsher. AML and anti-terror financing rules get tighter and tighter. The existing rules are transferred one-to-one to crypto, although this is hardly or not at all possible. If stuff is done in a decentralized manner, it's hard to use the same measures like for a centralized industry. This still is done all the time, and decentralized finance is expected to stick to the same rules. Fortunately, there are also some counterforces to this. Regulators realize more and more that if they are too harsh on innovations, they either don't occur in the first place or go offshore. Nobody wants to drive out the industries of the future or innovations to be made elsewhere. Although there is also the stance just mentioned, I am definitely worried that regulators will go after crypto hard if it becomes too big. Regulation in the end is a balancing act. Users should not get exploited, but you also don't want to hinder innovations and force crypto industry to move elsewhere. In the end game, I also fear that regulation will be used to hold down or even make some cryptos illegal. This will happen once it's becoming too big and fiat currencies lose their importance and significance. However, it is difficult to set the correct level of regulation to protect users while not stifling innovation. Sixth, there is also technological risk. Today, blockchain is top notch, but there could be another technology coming up that might replace it and make it basically worthless. An example is the risk coming from quantum computers, which might be able to break encryption sometime in the future. Seventh, there are not many use cases for cryptocurrency yet. To be precise, there are many potential use cases, but cryptocurrency is primarily and almost exclusively used for speculation currently. Almost no one is here for the technology. Everyone is just looking for the next 100x. Hardly anyone buys crypto for any other reason than to speculate. Even the main use case is speculation. DeFi stands for decentralized finance. It is mainly about investing your money even more profitably. Bitcoin was actually created as digital money, but it cannot fulfill this function. It is too slow and not scalable. BTC is mainly used to bet on its price appreciation. Furthermore, it's way too volatile to be used as a currency. It also is too slow and is not allowing for enough transactions. Fees on the main Bitcoin network are also often high, not allowing for everyday small purchases, as the fee would be too high compared to the low value of goods purchased. I know the objection. There is also the Lightning Network, and this can cure all the shortcomings. Yada, yada, yada. The fact is that the Lightning Network has comparably low volume and is very complicated to use and does not solve the issue as of today. Point number 8. Cryptocurrency is not a proven asset class yet. It could still be just an investment fad. The crypto market cap can still be a gigantic bubble that will bust soon, and we might just have experienced the beginning of the end. Bitcoin, Ethereum, and others don't have decades of history like stock markets. Investing into crypto is very speculative, and the risk of losing everything is definitely high. This is especially true when you are investing in smaller projects that often crash completely instead of delivering the expected 100x returns. Ninth, fraud. Additional risks that hold crypto back are scammers and hackers. Billions got stolen already. Many more will be stolen in the future. This is not only about smart contract risks like already mentioned before. Sometimes the developer itself run with the customer or user funds. Crypto also made scams possible that never would have worked otherwise. Ransomware attacks would be way harder to execute without crypto. Criminals will just request a payment in crypto once they infiltrated a user's computer. And crypto makes it easy to get paid and to cover tracks and remain unrecognized. Getting paid would otherwise be much harder. You cannot just request a ransom payment on a bank account, as this would be traceable, and banks can also freeze fraudulent accounts. Collecting the money in cash would also be way more risky, since there must be a ransom handover where criminals are regularly caught. 10th, centralization and governance risks. Everyone always assumes that crypto projects are decentral. The coins also advertise as such all the time. In reality, though, this is not true for many or most of the projects. Often cryptocurrencies still rely on a trusted entity, and development is dependent on very few people from the same country, often even the same town. The coins are often held by a selected few people for the most part, and concentration of funds is even bigger than in the non-crypto world. As projects rely on small teams, very often there are a lot of opportunities for mismanagement. For example, development milestones might be missed. Marketing fails are happening every day, and developers might just stop working completely. Decentralized governance is another potential risk factor. It's slow, and the power often is concentrated in the hands of a selected few, as already mentioned. The concentration of ownership is huge most of the time. This also is true for flagship cryptos like Bitcoin. Decisions can also have unforeseen consequences that are devastating, but they could still be very hard to change after the vote because there is no emergency off for the blockchain, and a new lengthy election is needed before changes can be reversed. That's the last risk factor I got on my list. Did I forgot something? Are you still bullish? Let me know in the comments. Thanks for watching. Don't forget to like and subscribe. Watch this video next to learn more about crypto's shortcomings.